Before we get into this week's video, next week is Thanksgiving, so I'll likely skip next week's video to spend time with family. But I'll continue to publish our Monday investments each and every week on our website, beatthestockmarket.com. Now, on to this week's video. Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 38.76%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 22.32%. It's also beating the S&P 500 since the portfolio was started. But our best performing portfolio so far has been our technology portfolio, which is an annualized return of 49.95% as of Friday. It has only been in existence since April of this year, so its return will likely fluctuate a lot, and it's very volatile. And like in last week's video, later in the video I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. On the next slide I'll talk about how the market did last week and how our portfolios did as well. But what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,694 after 151 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so we're buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. The tan line on the chart on the slide shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which, like I said, has only existed since April of this year, but has had the best performing portfolio over that time. And which, again, remember, it's very volatile, so it's not for everyone. The dividend portfolios are much less volatile. And for those who have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our site, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings and investing goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. In 2022, the year we started the portfolio, the market did not perform well, but because I do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value, as I said before, is over $2,694. The return of the portfolio has been 22.32% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and in the preceding year, the portfolio once again beat the market. Here's a look at our portfolio returns for last week versus several benchmarks. Higher yielding stocks did the best last week, with our high yield portfolio gaining 2.99% last week. All of our portfolios beat the S&P 500 last week. Next week, on Tuesday, we get the quarterly results of cybersecurity company CrowdStrike and enterprise software company Workday, both of which are in our tech stock portfolio. Then on Wednesday, we get the Fed PCE report, which is personal consumption expenditure, which could have a meaningful impact on the market. Then the market is closed on Thursday, of course, for Thanksgiving. And then the market closes early on Friday as people are out shopping for Christmas on Black Friday. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 38.76%, which is surprisingly higher than our Dividend-Growth portfolio, which has an annualized return of 24.79% over the same time period, and includes way more growth stocks than the high-yield portfolio. I would expect that the Dividend-Growth portfolio would have the higher return over the long run, especially since the high-yield portfolio has 0 tech stocks so far, but time will tell. I would think about supplementing the high-yield portfolio with some tech stocks for additional diversification if an investor was going to solely invest in the high-yield portfolio. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high-yield portfolio has only existed for nearly 15 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high-yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me. I keep expecting the high-yield portfolio to come back down to earth, but so far it hasn't. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 54% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our 2 main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, the average return has been much lower at about 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you're to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. BlackRock recently released a report showing that $10,000 invested in stocks that grow their dividends or stocks that initiate or start a dividend grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, the S&P 500 isn't the best comparison because S&P 500 includes both dividend payers and non-dividend paying stocks. So that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is to have a stock portfolio that produces 2 things. 1, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are 2 examples of stocks growing their dividend payouts over the years. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 per year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now up to 8.21%. Of course, investors buying the stock now are not going to get that high of a dividend yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in quality dividend growth companies. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would only receive 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has continued to grow the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted, which they did recently. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we start with a low weekly investment amount is because I want to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because of my brokerage account, oops, I went too far in the slides. Let me go back. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the model portfolio for the classroom project, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our Classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents because of inflation, for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents, for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our Dividend-Growth Classroom stock portfolio's annual return is 22.32%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 14.07%, a difference of 59%. Our high-yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our 2 dividend-paying Classroom stock portfolios. I also prefer our actively managed Classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. It's just an algorithm that chooses the stocks. SCHD had at times had large positions in stocks that I consider to be a value trap, and that's not a good thing. This slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right, the Dividend-Growth stock portfolio was started much earlier than the other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our Dividend-Growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, none of those tech stocks from the tech stock portfolio appear on this list yet. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio, but it only has 1 stock on the list, Tapestry, which has been sold. It only has 1 stock on the list so far because the portfolio was started 20 months after the Dividend-Growth portfolio. It also holds far fewer stocks than our Dividend-Growth portfolio, probably about 1/3 of the number of stocks. Stocks in yellow have been sold. Best performing stock so far has been Evercore, which we sold recently. It provided us with a 252.9% return in a little over 2 years. Broadcom, a chip maker, remains at number 2 with 196.5% total return since its initial purchase. The fastest risers that are still in the portfolio are NVIDIA in our technology-themed portfolio with a total return of 194.9% in 10.7 months. PHINIA with a 97.4% gain in 15 months, and Bank of New York Mellon with an 85.8% total return in less than 14 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. This slide shows our best performing dividend stocks last week for our Dividend-Growth portfolio. It does not include dividends. The best performers last week tended to be the value stocks rather than the growth stocks. The best performers were Vestas Corporation at 15.6%, WK Kellogg at 9.5%, and Interpublic at 9.2%. And this slide shows our best performing dividend stocks last week for our high yield stock portfolio, which has far fewer holdings than our Dividend-Growth portfolio. The best performers were Interpublic at 9.2%, CVS at 9%, which is a deep value stock, FMC, which at 8%, I consider that to be another deep value stock, and AbbVie at 7.2%. And this slide shows our best performing stocks in our pure tech stock portfolio last week. The best performers were Globant at 12.8%, CrowdStrike at 10.5%, and remember Tuesday is going to release its quarterly earnings, so that'll be a big day for that stock. And then Marvell Technology and Salesforce. And finally, this slide shows our best performing stocks in our tech-themed portfolio. The best performers were Snowflake at an astounding 33%, Cloudflare at 16.1%, UiPath 15.2%, and GitLab at 11.3%, and then CrowdStrike again. Now, before we look at the 10 stocks we bought this week, here are the dividend-paying stocks we bought a year ago, along with their total returns, which of course includes dividends. Stocks in yellow, like Tractor Supply and Lazard, have been sold. On the left side of the screen are the dividend-growth stocks we bought a year ago. We usually buy 10, but for some reason I bought 11. I can't remember why. Stocks in yellow, like I said, have been sold. Bank of New York Mellon has been the best performer so far with a 73.8% total return in a year. The average return of the dividend growth stocks we bought a year ago is 26.5%, with 4 stocks being held for less than a year because they were sold. The annualized return of all of those bought a year ago is 29.44%. Dollar General at the very bottom has been a big drag on that average. On the right side of the slide are the 8 purchases we made for our high yield portfolio. It utilizes 2 different strategies, and the strategies often overlap, meaning we often make 2 purchases of the same stock. And you can see we bought Best Buy once for each strategy that week. The average return of the high yield stock purchases we bought a year ago is 34.19%, despite 6 of the purchases not being held for the full year. The annualized return for all of the high yield purchases is 59.43%. Obviously, our purchases won't continue that high of a return. Here's the usual financial disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas off the internet, but you always need to do your own due diligence. In other words, do your research. On Monday, we sold 2 stocks. We sold Crane Holdings for our dividend growth portfolio. The company had a huge run-up, providing the portfolio with a total return of 132.7% in less than 18 months. We sold it because it now appears to be fairly valued, and its 4-way rating of valuation, quality, recent dividend growth and yield, and future dividend growth potential has fallen to the bottom 20% of stocks. And for our tech stock portfolio, we sold EPAM Systems for a 26.6% gain in 5 months, which is an annualized return of 73.7%. We sold EPAM because it now appears to be a bit overvalued. Now on to stocks we purchased this week. So for our dividend growth portfolio, 90% or so of the portfolio is comprised of high quality dividend growth stocks. But the other 10% or so is invested in what I call under-the-radar dividend payers. So last Monday, we bought an under-the-radar dividend payer called Alight, ticker symbol ALIT. Alight, which recently announced it will start paying a quarterly dividend, provides cloud-based integrated digital human resources and business solutions worldwide. Now let's talk about the dividend growth stocks we bought last Monday for the dividend growth portfolio. Here are my rankings for the top 15 dividend-paying stocks this past week, but remember, we only buy 10 per week. We purchased the first 10 stocks on the list that are not in yellow, and this week, none of them are in yellow. If they were in yellow, that means they comprise 4% or more of the portfolio, and therefore we don't invest any more in them because we don't want our portfolio to get top-heavy. So America Mobile makes our list for the first time. It is the largest provider of wireless services in Latin America and is one of the 10 largest in the world. Now, if you're retired and living on your dividends, you need to be aware that American Mobile pays a variable dividend, and it pays it twice a year, not 4 times a year. It also occasionally will pay a large special dividend. So if you're wanting a company that provides regular dividends, and you always want to know how much you're going to get, you may want to consider a different stock because America Mobile, it's a variable dividend. And like I said, only pays twice a year. Taiwan Semiconductor is making its second appearance in the portfolio. I sold Taiwan Semiconductor a while ago, and I sold it way too early when it first appeared in the portfolio, and I ended up regretting it. So I'm glad it's back in the portfolio at a good price. This week, none of the stocks in our top 15 made up 4% of the portfolio, so that's why none of the stocks are in yellow, although Microsoft was very close. Remember, and I'm getting a lot of questions on this. Remember, we use many criteria to filter stocks, and if they are hovering at the required level, they can make the stock list one week and then drop off the list the next week based on a very small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the 12 months, which changes frequently. Now for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and then make the list. But the next week, its estimate might dip down to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria that we use to narrow down the list of inevitable stocks, or investable stocks, not inevitable. So they can appear one week and not appear for just a very small change in one of our metrics. So like I said before, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account in cash. We then take that combined total and split it amongst the 10 stocks that we were purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. The table on this slide includes the company's sub-industry, how undervalued they are according to our research, the risk rating, quality grade, and dividend yield. The most undervalued stocks last week appeared to be America Movil, Thermo Fisher, Nike, and Microchip. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks portfolio in the next few slides. Last week, I purchased over $3,200 of the stocks from both the dividend growth portfolio, the high yield portfolio, and the tech stock portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF SCHD and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns, and I'll share the results with you as I get more information. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% or so far have been invested in those smaller, under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. Risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Microsoft, Nike, Taiwan Semiconductor, and West Pharmaceuticals. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Thermo Fisher and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, America Movil, KLA Tencor, Huntington Ingalls, Microchip, and Merck. All these earned an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are, not usually anyway, companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth of those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Lam Research, Thermo Fisher, West Pharmaceutical, and Agilent Technologies. These earned a B or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Lam Research, America Movil, Thermo Fisher, KLA, Tencor, Microsoft, and Taiwan Semiconductor, all having earned an A or B grade for both. Here are our trade confirmations from last Monday for the Dividend-Growth stock portfolio. We took the weekly deposit, plus any dividends that had recently been received, plus proceeds from the sale of Crane Company, which we sold, as you can see in the green at the bottom, and then invested the total into the top 10 stocks on a buy list for the week, as long as the company does not have a portfolio allocation of 4% or greater. Sometimes instead of dividing evenly across all 10 stocks, I try to invest a bit more into the higher ranked stocks, but this week I try to equal weight the investments as evenly as I could. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 to 5. However, the downside is this reduces the portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns by over 50%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's value. Normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in the first bullet point. So far, not limiting individual stocks to 4% of the portfolio would have improved annual returns by about 24%. But again, I personally prefer a more diversified portfolio. Technique number 3. The under-the-radar dividend payers, despite having some incredible performers like F&G Annuities 119% gain in 12 months, and Repositrax 97% gain in the same time frame, on average they have not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar dividend payers are very small companies, and small stocks have not performed as well as big stocks or large cap stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And technique number 4, you could sell when a stock is fairly valued, even if dividend and quality metrics are excellent. So we don't sell often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own evaluation methodology, like PE ratio, and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in the stocks or in that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's return by not holding on to fairly valued stock. If you try this, I'd be very interested to hear your results over time. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And let's talk about ways to have a less hands-on approach. Here are some ways to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week, as opposed to every other week or monthly, is you get more diversification because the stock list changes every week. So if one does not mind less diversification in their portfolio, option one is to invest every other week or monthly instead of weekly. Option two is to just buy the high quality stocks, meaning those with a quality ranking of B- or better, and hold forever. In other words, you don't sell. Over time, some will turn out to be clunker stocks, but they will just become very small parts of your portfolio as you let your winners run. Now, in the case of me selling Taiwan Semiconductor early and regretting it, it would have helped. This option would have helped because it would have prevented me from selling Taiwan Semiconductor. All right, on this slide, we're looking at our stocks that have raised their dividends recently. Now, the holy grail of investing, like we said, in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Last week, Merck raised its dividend by 5.2%. The last 22 dividend increases for the portfolio have an average of 10.3%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we receive once a stock split has occurred. And we'll need to do that in several weeks when Energy Corp splits 2-for-1 on December 13th. Here's a look at the top 10 stocks that make up our largest portion of the Dividend-Growth portfolio as of Friday after the market closed. American Express overtakes Visa for the number 1 spot, and Microsoft moves up a spot to number 3. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true, like we mentioned earlier, that our portfolio's return would likely be higher if we'd only invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation, but that also creates a more concentrated, more volatile portfolio. And many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the wrong time. Our portfolio holdings are now up to 102. So far, around 100 seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. I think our highest we've been at was 103. That might seem like a large number of companies to keep track of, but the spreadsheet that we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly, and doesn't take that much time. But creating the spreadsheet took about 2 years because it's pretty complicated and pretty big. Now let's talk about our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our Dividend-Growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. I did not have high hopes for this portfolio because I believe more in Dividend-Growth stocks, but so far I've been proven way wrong. The portfolio as a whole has an annual total return of 38.76. Since the portfolio has been in existence for nearly 15 months, that return will likely fluctuate a lot more than the return for our Dividend-Growth stock portfolio, which has existed for about 34 months. Currently, the high-yield portfolio's dividend yield is 4.06%, but the companies in it likely won't grow their dividends as much as the stocks in our Dividend-Growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 5.07%. Now, two strategies are being implemented in this portfolio, as you see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 22.55% and has been held for an average of 188.5 days so far, which is an annualized return of 48.31% using Excel's rate function. Now, it's not likely that the portfolio could keep up an annual return that high, obviously, since stocks historically average about 9 to 10% per year. On this slide, we're looking at the high-yield dividend-paying stocks we bought last week. And because the high-yield stock portfolio currently lacks any technology stocks, for those that want to add diversification to the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off, so don't chase the yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies. Strategy 1, remember, emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close to it. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 different rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2, like America Mobile did. If that's the case, instead of the stock getting a 1/8 weighting, they get 2 eighths, which is 1/4, which is equivalent to 25% of that week's investment. Both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. The high-yield stocks we bought last week while implementing Strategy 1 are Bristol-Myers, good old Bristol-Myers, America Mobile, CVS Health, and LyondellBasell. The 4 high-yield dividend stocks we bought last week while implementing Strategy 2 are America Mobile, Merck, Gilead, and LyondellBasell. Now, Gilead is making its second appearance in the portfolio. We successfully sold it earlier for a nice gain, and now it looks like it's a good bargain again. This week's purchases have an average yield of 4.4%, with Lyondell coming in the highest with a 6.5% dividend yield. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio on average, which consists of stocks that usually have lower yields but a greater potential for excellent future growth in those dividend payouts. Here are our trade confirmations from last Monday for the high-yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received and then invested the total into the 8 stocks on our buy list. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 amount and seeing how far it can grow. The tech themes we built this portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector, not the tech sector. So far, the portfolio has gained 35.9% in nearly 11 months. In comparison, technology ETF with the ticker symbol XLK is up 22% over the same time period, and the S&P 500 is up 26.5%. The best performers so far are NVIDIA at 194.9%, Meta, Fortinet, SAP, ServiceNow, Broadcom, and CrowdStrike. And back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Because it's the first year, we've not boosted it yet. We will at the end of the year. I hesitate to call this a portfolio since it's limited to only one sector, but it's been fun to follow, especially with all the volatility. Since this portfolio started, it has outperformed the two dividend portfolios over the same time period. Tech stocks have been very, very volatile, though. So one investing in this has to be comfortable with big swings up and big swings down. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio in the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the tech sector like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 101.3 days and has produced an average return of 11.9%. Using Excel's rate function, that's a 49.96% annualized return. If we had instead invested our weekly investment into XLK, which is a technology ETF, instead of an 11.9% average return, we get an average return of 6.09% with the same average holding period, which would be 22.6% per year. The portfolio is also outperforming the S&P 500, but remember the volatility is very high, so it's not for the faint of heart. Note that all these stocks are higher quality, meaning they must have a quality rating of B- or better. Also note that the ranking system used here for the tech stocks may differ from the rankings we use to rate dividend-growth stocks. Because many tech stocks do not pay dividends, therefore in this ranking we ignore the criteria that involves dividend growth, dividend payout ratio, etc., but we use the valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. The top four tech stocks in our ranking last week were ASML, Lam Research, Adobe, and NICE. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on beatthestockmarket.com, which has real-time transaction data on Mondays when we make our weekly investments and anytime we sell a stock, as well as information about portfolio holdings. Have a great Thanksgiving, and I'll see you in 2 weeks. But I'll still have our Monday purchases posted on our website. See ya!